All right, look, we have very strong, we've got a rally, lots of good news, good inflation numbers, Trump takes office in 5 days, bank earnings strong. Have I got it right? Have I missed anything out?
You have not. And the most important thing this morning to me is the reaction in the bond market. Last week, I shared with you and the viewers that we would like to have seen the 10-year get under 4.7% because that is really bullish. And that's what the reaction is right now. So right now, this is a very bullish sign. However, I don't want to spike the football because the bottom line is core inflation, and inflation is still 50% higher than the Fed's target. And we think by the time we get to the second quarter, we're going to see inflation continue to reaccelerate. So the battle with inflation is not over yet. And there's going to be a lot of zigging and zagging in this market this year.
But that's an extraordinary drop in the 10-year Treasury yield. Yesterday, at this time, we went on the air saying the 10-year's at 4.80. Now you're all the way down to 4.66. Is that just because of mildly favorable inflation numbers?
It's that, and then the manufacturing numbers that came out today were really weak as well, too. And that's also contributing to the 10-year bond coming down. But mainly this core inflation, people were really worried about the acceleration being too fast and getting that 10-year to 5%. And now we're getting a cooling off. But again, I think you're going to be range-bound in this 10-year, and I do expect it to get to over 5% sometime in the first half this year.
I read your stuff, as everyone knows, and you say that buy and hold doesn't work anymore. Hold on a second, Eddie. I've done that my entire life, buy and hold. I've not always done well with it, but mostly I have. What's wrong with buy and hold now?
There's nothing wrong with buy and hold, Stuart, but we still take on new clients each month. And the number one thing they share with us in this new market environment with volatility is they want an actively managed strategy. And that means that when things are bullish in whatever asset class it is, stocks or bonds, you buy. But when they turn bearish, don't just say, ride it out, it will come back. Pivot and go into other areas that the trends are stronger. And I think 2025, there's going to be a moment in time where investors are going to need to really de-risk because there's going to be some asset classes that take a big hit because there has to be tough decisions made by this administration to get our balance sheet back to where it is. And that's going to be very negative short term for risk assets. So why would I tell someone to ride it all the way down? If I see danger, we're going to sell. If we see trends up, we're going to buy. And that goes for fixed income as well, too.
Okay, if I have some spare cash on hand and I go down to my broker's office this lunchtime, what should I buy?
So right now, I wouldn't buy anything at the open because I want to see how strong the market is. But of course, depending upon your asset allocation, fixed income, there's some great yields. Some of our yields on some of our fixed income is between 7 and 8% that we're getting on the fixed income side, which is very attractive for our clients. Yeah. But we are still bullish. You know, we've still bought tech on dips. Now, we did raise a little bit of cash last week as certain trends broke down. So we're going to wait and watch and see how things go. And then we'll go back into those names that we sold last week. But right now, I think you have a lot of opportunity in fixed income. But this market is still very narrow, and there's been lots of damage in other asset classes that we have stayed the heck away from.
Okay. Eddie Ghabour, thanks for joining us on a very important day. Big rally on Wall Street. Thanks, Eddie.